In this week's video, we'll review the latest charts and take a detailed look at stock market history to help us answer the question, how bad could it get for buy and hold investors? When we head into a football game, the higher our level of understanding relative to what our opponent is capable of and what they're not capable of, the higher the probability we're going to react to it properly in real time during the course of the game. In recent weeks, we've covered two sets of historical examples that may help us better understand what could unfold in the coming days, weeks, months, and years. In the second and third half of this week's video, we will update these charts and these charts using charts from Friday's session. But before we do that, let's do a little bit more historical film study to give us a better understanding of what we may be up against going forward. It's a daily chart of the S&P 500 index during the trading session on Thursday, February 7th, 2019. To set the stage, S&P 500 peaked in September of last year. On an intraday basis, fell over 20%, and then we've had this V move off of the low. Since we're all susceptible to recency bias, it's very, very easy after a move like this to assume that the worst is behind us. Just as it would have been very, very easy to assume that the worst was behind us at this point in 1973. We get a strong rally, the S&P 500 retakes the 200-day moving average in red and then appears to have a successful retest and then starts to move higher. Was it fair to say that the worst was behind us from this point here? If you know your market history, you know the answer is a definitive no. After retaking the 200-day moving average and staying above it for several weeks, really bad things happened. From this point here to the low in October 1974, the S&P 500 lost an additional 44%. It's important to note the slides that follow are not meant to be a forecast in any shape, form, or fashion. Often in these circumstances, when you get a big drawdown and then a multiple week move off the low, it becomes very, very popular to talk about how attractive buy and hold investing can be. It's also important for us to understand the downside to buy and hold investing. From a historical perspective, how large can the drawdowns get if we use a buy and hold strategy? In the 1980 case, the loss was over 27%. In every case that follows, this level here hypothetically assumes if this was our peak and we fell 27%, the hypothetical low in the S&P 500 in the future would be below 2150. History says we don't know whether we're out of the woods yet, and it can be very, very dangerous to assume the worst is over here, and very, very dangerous to assume the worst is over here. And from a historical perspective, not really safe to assume the worst would be over here, hypothetically. The 1961 case was a little bit worse. In the 1962 case in the U.S. stock market, the drawdown was over 28%. There's nothing wrong with buy and hold. Everything that we've been told about buy and hold up here is accurate and true. But we also have to understand, to successfully implement a buy and hold strategy, you have to hold through what can be massive and devastating drawdowns. From a historical perspective, how much worse can it get? 1946 case, we almost reached a drawdown of 30%. And from a how can all of this help us perspective, in the present day, we really don't know what this move is here yet. That's to be determined. On one end of the spectrum, this could be the low, and the market could go on to make a series of higher highs above the 200-day moving average. On the other end of the spectrum, it's also well within the realm of possibility that the present day is a 100% normal and to be expected counter trend rally within the context of an existing downtrend. And if that's the case, after the counter trend move, the primary trend resumes, which in this case would be a series of lower lows. And in these historical cases, if you're running a buy and hold strategy, in order to do that successfully, you have to stay the course between point A and point B. And there's nothing wrong with that. It's just something that we have to understand about that type of strategy. And as we walk through these historical cases, we begin to realize that extremely large drawdowns do occur from time to time, and they might not be as infrequent as we've been led to believe. 1987 case, in the present day, hypothetically, if we experienced the same peak to trough decline, we would move from this point here, hypothetically, down to roughly 1875. And a fair response might be, well, that's an extremely rare case. And you also may have noticed that this line is a little bit thicker than these lines. There's a reason for that. Because the 1968 case, this is actually two lines, experienced a very, very similar drawdown to the 1987 case. What does history tell us if we assumed the worst was over here? History says not only can it get worse, it can get much worse. And remember, in this case, it would have been very, very easy to feel like we were out of the woods here and the worst was behind us. Just as in the present day, it's very, very easy to assume that we're out of the woods and the worst is behind us. That very well may be the case, but that's to be determined. The other takeaway here is if you never cut your losses, never draw a line in the sand, your drawdowns can just get worse and worse and worse and worse. Even if we hit 48% from this level here to this level here, history tells us it's not safe to assume that the worst would be over. In the dot-com bear market, the S&P 500 lost over 50%. If we experienced a similar decline in the present day, the S&P 500 would bottom somewhere in the neighborhood of 1450. Today it's trading around 2700. How much worse can it get? Quite a bit worse from a historical perspective. If we experienced a similar decline to the financial crisis bear market, the S&P 500 hypothetically would drop below 1250. And history says it wouldn't even be safe to assume the worst was over here. In the 1937 case, the S&P 500 dropped almost 60%. If we experienced a similar decline later in 2019 or in the years ahead, the S&P hypothetically would drop below 1200. Again, there's nothing wrong with a buy and hold approach, but we have to understand to successfully execute a buy and hold approach in every one of these cases, we would have to just look the other way and take it on the chin and experience extremely painful and difficult to sleep at night drawdowns. Does history tell us it would be safe to assume the worst is over here? Well, in the most extreme case, the 1929 case, the answer would be a definitive no. Hypothetically, in the extreme case, if the S&P 500 experienced the same decline that the Dow did in 1929, we would fall from this peak here around 2,900 in September of 2018 and would drop below 400. And it may seem extremely far-fetched that something like this could happen again. But it doesn't seem so far-fetched when you think about this decline here in the context of the known information that we had in hand during this decline. Which would beg the question, what happens if things really get bad economically in the present day? If we can fall this far, this fast, with the data that we had in hand here, it's really not unreasonable to assume that we could fall a lot further if we went into a recession and/or a severe recession in the coming weeks, months, and years. Once again, our purpose is not to forecast anything, but rather to better understand the wide range of outcomes that we could experience in the next 20 years at some point based on real-world history. In the stock market, it's very difficult to say that something that's happened before can't happen again. Every single one of these drawdowns occurred in the real world, and since most risk assets are highly correlated, even diversified buy and hold portfolios can experience massive drawdowns. So let's assume under a worst case scenario, hypothetically, if this turns out to be a counter trend move within the context of an existing downtrend, how much worse could it get from here if history repeated itself? Since every single one of these lines is based on this peak here that occurred in September of 2018, and we know where the S&P 500 was trading on February 7th, 2019, we can do the math and answer that hypothetical question based on these real historical examples. Thus, if we had $1 million invested in the S&P 500 index hypothetically on Thursday, February 7th, 2019, and this ended up being a counter-trend rally within the context of an existing downtrend that ended up bottoming at one of these levels here, then the hypothetical pain that we could experience, additional pain, this doesn't include the pain from this peak here, the additional pain from February 7th, 2019, on average could be a 40% decline, and the median decline is almost 31%, telling us if we have $1 million hypothetically invested in the market and history repeated itself in the worst way possible, then our $1 million hypothetical portfolio from February 7th would lose an additional $300,000 to $400,000 after this counter trend move, telling us with a still concerning and mixed prove it to me profile, it's extremely important that we respect a wide range of outcomes and have a very good understanding of what history tells us has already happened in the real world. This segment of the video will update charts and concepts that were originally presented on January 11th. You can find that video on the Shivako Capital channel on YouTube or on our blog, Short Takes. Before we get started, we should remind ourselves we didn't arbitrarily pick any of the historical cases covered in these videos. Every historical case has something very similar to the present day. And we know in the 1987, 2011, 1998, and 2016 cases, after the original plunge low, some type of stock market retest occurred. And we also know in the 2011 case, the orange 200-day moving average acted as resistance, and then there was another retracement here. Similar situation in the 1998 case. We had the plunge, the market came up off of the low in somewhat of a V-shaped manner, was rejected at the orange 200-day moving average, and then retested the original V low. And we know from a probability perspective, when we move to the present day charts, bullish odds increase if the market can confidently plow through the 200-day moving average and consolidate on the other side of the 200-day. And using this chart in an earlier video dated January 25th, we said we would learn something either way as price moved into the moving average cluster. In many of the bearish cases, price was unable to sustain any type of move above the cluster. This counter-trend rally in 2008, strong rally, was rejected at a downward sloping orange 200-day moving average. And remember, in our 2015 case, we moved above and below the moving average cluster, including several moves above the 200-day moving average. Thus, during the trading session on Friday, February 8th, do we have a look like this, where price might be struggling near the 200-day, a look like this, where price might be struggling near the 200-day, or have we morphed into one of these confident blow right through the 200-day looks? Well, it's probably too early to make any definitive statements about the outcome in the present day. During the trading session on Friday, February 8th, thus far, price has moved back into the cluster and has stalled right around the orange 200-day moving average. In this case, we had a significant retracement, and in this case, we had a significant retracement almost all the way back to the original low. Therefore, we will continue to learn something either way. These are simply guideposts. We know this with 100% certainty. If really good things are going to happen in 2019 and 2020, the S&P 500 absolutely positively will clear all of these moving averages, and the slopes of these moving averages will start to look more like this. That's all to be determined. Thus far, we don't have a clear and hold look, but history tells us that we can consolidate inside of the cluster before making a confident push above the orange 200-day moving average. It's very, very difficult to say on Friday, February 8th that the look of this chart here is discernibly different from the look in here, or that we could morph into a look like this as well, telling us the jury is still out on what happens in the coming days, weeks, months, and years. And if you're a client, that uncertainty is reflected in our current positions. And most importantly, on Friday, February 8th, 2019, are we allocated in line with the observable evidence? The answer is yes, and we'll continue to take it day by day. In last week's video, we used this February 1st S&P 500 chart to make the argument that 1998 has a similar look to the present day. In 1998, we broke above the downward sloping green trend line. We came up to this area of prior support. It's about a 7-month period here. In the present day, the similar line is about an 8-month period. Last week, we had also cleared the downward sloping trend line and looked like we were trying to clear this blue line here, which is similar to this line here. If we fast forward to Friday's session, at roughly 10:56 a.m., with the blue line, it looks like we had a bullish breakout above it, and it's possible that we're retesting that breakout now, or we're going to get a failed breakout. A little too early to make that call, but given what we know right now at 10:56 a.m. on February 8th, you can still make the argument that this looks similar to this point here. If we add in the green trend line, it's possible that we'll retest this breakout find support at the green trend line, and then move in this direction. And remember, last week we also pointed out that this look here, you can make an argument, is similar to the look on February 8th. And it also turns out that this rally attempt and subsequent failure in retest of the low also occurred at the orange 200-day moving average that we're trying to test in 2019. Now let's update our 100 and 200-day moving average analysis that was originally covered on January 25th. You can find that detailed analysis on this blog post, on our website, or on the Shivako Capital channel on YouTube. The video is dated January 25th. We just updated the charts on the right side of the screen. Now we're moving to the left side of the screen. Remember, it's relatively rare to see the blue 100-day moving average cross below a flattish or downward sloping 200-day moving average. And in that original analysis, we covered all of the similar historical cases dating back to 1950. This is the look of the chart a week ago. If we fast forward to February 8th, we can see the S&P 500 has come up to the red 200-day moving average in this case. In the previous charts, this was orange. It's red here. And on the first pass, the 200-day moving average has acted as resistance. One subtle difference with this look here. Notice here, the 200-day did not act as resistance. We retook it fairly easily. Same thing here, went right above it. Same thing here, we're able to close above it. This does look a little bit different thus far, but we have to note it's only 11 a.m. on February 8th. So it's possible that the S&P 500 will close above the 200-day moving average either during Friday's session or sometime next week. Right now, the look of this chart relative to this look back here in a subtle manner has a little bit of a bearish bent to it, at least in the short run. You may remember in the original analysis, we found 21 similar cases where the blue 100-day moving average crossed below a flattish to downward sloping 200-day moving average in red. And from the day of this cross here, about 80% of the cases had a relatively significant retracement from where the S&P 500 was trading on the day of the cross, and about 95% of the cases at least backtracked in some way. And if we did the math and figured out how far the market backtracked from the day of the cross, if we had a similar median outcome, the S&P hypothetically could move back to 2332 in April of this year. And if we had an average outcome relative to these 21 cases, hypothetically, we could move all the way back to 2244 and hit that somewhere in the neighborhood of Independence Day 2019. Not a prediction. The analysis just simply helps us understand how markets have behaved in the past, on average, and in the median case when we see something very, very similar to what we saw in mid-January of this year. And from a visual perspective, if we put these figures on a 2019 chart, in the median case, we would undercut this closing low that was made in late December 2018. And in the average case, we would undercut that low fairly significantly. That low was somewhere in the neighborhood of 2350. In the average case after this cross, the low didn't come on average till somewhere in this area here relative to where the S&P 500 was on the day of this cross. This analysis by no means negates bullish outcomes in the present day, but it does help us keep an open mind about some type of retracement or give back off of the V low that we've experienced. To give us a visual reminder of some of these cases here, 1957, there was a rally and a retest. 1960, we made a significant lower low. 1962, significant lower low. 66, significant lower low. Concepts that are captured visually on this chart here. Since we know with 100% certainty that 2019 will trace out a very unique path relative to any historical case that we can reference. Thus, it's extremely important to understand bullish probabilities and better than expected outcome probabilities as well. And that's very, very easy to do if you reference this January 21st short takes post. You can find it on our website. And while the odds after a similar breadth thrust in the past lean heavily bullish, the most similar case was 1962, and we have to remember that in that case, after somewhat of a V move off of the bottom, over 61.8% of that V move was retraced before the market moved higher. History has been telling us and continues to tell us that we have somewhat of a mixed, this could go either way picture. And thus, we feel very, very good about the patient, prudent, measured, and data-dependent approach that we've been taking over the past few weeks. Given this is the look of our generic and for illustrative purposes only moving average cluster during Friday's session on February 8th, and this is the look of the exact same moving averages on December 7th, 2001, and given the still concerning and we best move in a patient, prudent, measured, and data-dependent manner readings in our model based on hard data, no opinions, it's very, very difficult to say that the look of this chart on February 8th obviously leans bullish. December 7th, 2001, that's this period right here where price bumps up against the orange 200-day moving average. After that, we had consolidation, and eventually the market moved from this point A to this point B and lost an additional 34%. Not a bearish forecast, just simply acknowledging the market's present-day risk-reward profile. If the profile improves, the data will improve, and we're happy to start scaling in at a much faster rate. At this juncture, we have a very high respect for the possibility of wildly bullish outcomes. And the look of this chart here on February 8th with price still under a flattish 200-day moving average tells us to still respect wildly bearish outcomes. On May 16th, 2008, after a sharp counter-trend rally within the context of an existing downtrend, price ran into a flattish 200-day moving average, and then really bad things happened. We'll continue to take it day by day with a flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice and Shavacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.